Good afternoon, esteemed partners. Welcome to HSBC Mutual Fund's Outlook event on equity markets and portfolio construct. I am Kripa Iyer, Zonal Head West, welcoming you all for this session. We have with us Ms. Chinu Gupta, who is a Senior Fund Manager with HSBC Asset Management. She has more than 18 years of enriched experience. She joined us in L&T in 2021 July. Before that, she was with Canara Asset Management. She manages two equity funds, HSBC Large and Mid Cap, HSBC ELSs, and two hybrid category funds, HSBC Aggressive Hybrid and HSBC Equity Savings. Chinu has dynamically been managing the portfolios. Today, she's going to talk about in depth the market outlook, her thought process in terms of the portfolio construct. This is going to be a very engaging session. You will all have your Dropbox where you can feed in your questions. And post the presentation, we'll have the Q&A session with her. Without much ado, I'll invite Chinu. Chinu, welcome to the session.
Yeah, thanks, Kripa. So good, yeah, happy to carry on with this presentation. So we'll talk about the investment outlook and the portfolio construct that I go about doing in various schemes as such. So just to start off here, yeah, this is going to be the flow of the presentation that we're talking about. We'll talk about the current investment scenario. Important to talk about flows here because they've been very dynamic. We'll also talk about the valuations because that is one big concern on everybody's mind. Then we'll come down to the investment themes. How do we see these investment themes, especially while constructing the portfolio, and so on. So yeah, to start with, and talking about the current scenario, just broken it down into three pieces, the way we would want to see it. There are some positives, some things which are in a no concern area, and obviously certain negatives. So what are the positives here? To begin with, I think we are all aware that government spend has been the most encouraging thing in last couple of years. Even if we talk about this half fiscal that has just passed by, government spend has been very supportive. We've already spent 50% of our budgeted spend, which has never before happened up to September. Tax collections have also been up to the mark. They've been inching up. You all have seen GST numbers, very encouraging. So these two things have definitely been on track. Again, if I talk about positives, it's the government policies, especially on the PLI and other fronts, the way we are moving step by step, that is certainly encouraging. And the domestic flows continue to remain quite positive. When I say no concern area or the neutral zone, it is the corporate earnings. So clearly corporate earnings have been supported initially by good volume growth post-COVID that we saw. And now, if you're seeing in this year, it's more on backdrop of improving profitability. So earnings growth have been there, volume could have ebbed, but certainly the margin expansion have sustained the corporate earnings. Talk about domestic inflation. We are in a very comfortable zone, around 5%, especially compared to the global scenario where developed nations are still battling with inflation. Yes, it's not as concerning as before, but still higher than where they wanted to be. I think our domestic inflation has been a lot more comfortable. Again, the last point, political environment, couldn't help but put it here. Next year is the year of elections. Ideally, it would have been a very nervous year for us, but I think compared to 2014 or 2019, I would like to place the political environment in a neutral zone for now. Yes, the negatives. And why the negatives are important? It is essential to understand that today when we are sitting and talking about investments, everything is not hunky-dory. There are certainly concerns while we are sitting here. Talk about the rural demand. So that has been a concern point for quite some time, still continues to be concerning. And obviously we've seen that monsoon has lagged to a certain extent this year. So that is one negative. That demand is still missing. So most of the consumption-oriented companies in the country are battling this. The next negative is the export. So if I talk about the other group of companies which are more on the manufacturing side, etc., they also have certain piece of their earnings coming in from export, around 20-30% at least. And this export has been a pain point. So right now it's very, you can say at the extreme side because of the global destocking that is happening. But at the same time, there is also a concern of global slowdown. So today, as we are talking, this is essentially one of the negatives where we are sitting. Even the earnings season where we are seeing the earnings, they are in the backdrop of these negative exports. Again, talking about FI flows, they have been swinging from positive to negative. So we've seen last 3 months, again, FI flows have come to outflows. So they continue to be negative, especially with such high Fed rate, US 10-year yield where they are. I think FI flows is something that will still take some time to sustainably come back. And yes, valuation, which are the concern on everybody's mind. So just taking you through these two areas as we are talking about, which is the flows, right? The first one, FI flows, as I said, initially in the beginning of the year, we saw a good amount of inflows coming in. Then gradually in the last 3 months, we've seen $5 billion of outflows. Even on a year-to-date basis, we are still positive. But however, this is the scenario. Domestic flows, which we know have been very supportive. So I think this is one big pillar which is coming in. And in this backdrop, if I have to tell you, I think it's equally important to talk about ownership in the companies, no? BSE 500 companies, if I look at ownership, look at where the FI ownership is as it stands. So since a long time, I think right from 2015, we've seen FI ownership to be in the range of 20-21%, right? Even crossing 21% at times. And today, as we are talking, FI ownership in these companies has come down to 18%. And this has happened on a very healthy backdrop. This is a domestic mutual fund ownership of these companies. Look at how the ownership has inched up. So domestic mutual funds used to be really small in the last decade. You know, they were less than 4%. But look at this healthy pickup in domestic institutions. Obviously, this is not including your insurance and other institution, which would be similar 8-9%, but that is how they've been throughout it. So I'm just talking about this domestic mutual funds. So you can look at this interplay where the ownership has moved from this FIs towards domestic mutual fund, which is a very kind of sticky ownership, a healthy ownership that we would say. So that is the change in pattern. Obviously, one talks about retail participation in the market seems to be a lot heated up. But just look at this retail ownership data, right? Ownership seemed to not have changed much. From, you can say, 7.5% average, you are at 8.8%. Some up move, but that is not very dramatic. So retail participation would be there in terms of FNO, etc. But when it comes to ownership, I think it's still very good. Moving on to valuations, because yeah, that is one big concern. I think entire industry has been talking about it. And so yeah, definitely let's touch upon it. Just putting valuations in a backdrop of 1 year forward. The reason being we are in FY24, how FY24 earnings shape up, they will really not move the market much. A lot more is dependent on how FY25 shapes up. So looking at companies' valuation through that perspective, 1 year forward valuation, if I look at the large cap valuations. So this is the NSE 500 valuation chart that I've put up for last 7 years. And you can see at the average line, we're just there. And that is the reason where you say that large cap valuations, there is not much concern because we're just there at the average valuations. So today we cannot say that the markets are overvalued because the large cap, which is like 70-75% chunk of the market, it is still in a very comfortable valuations. Let's talk about the next category, which is this mid cap, the next 150 companies that we talk about. Yes, here you can say that versus the average, valuations are high. But I just again put the 7-year chart to show you it is nothing very exceptional. It's not that I think in last 7 years, several times we've been in that range. So it's not that we are some bubble that we are sitting. Even I would say, yes, mid-cap valuations are expensive from 23.8 times. I do not see further re-rating possible. But this doesn't look like somewhere where you are heading for a collapse. So there is discomfort in valuation for sure. Coming to small caps, again, small caps also we've seen inching up in valuation. That is happening. They are now at 18 times, very much at par with large cap. They are not as concerning as the mid caps, which are at 23, 24 times. Definitely, they are out of the league where they have been in the past. Now, here it's important to see what is changing in the small cap universe and should the valuations be where they are. I think we'll talk about it as we move through the presentation. And I think this was one interesting point that I thought of highlighting. This is just talking about FI's portfolio construct that we've seen changing over last 1 year per se, right? September 22, you can see the first part is the large caps, then you have the mid caps, and then you have the small caps. And look at the space where you've seen increase. And I think it is relevant to notice here, in last quite a few years, this is perhaps a time that you're noticing very active interest by even the foreign institutional owners in the mid and small cap space. And there are several reasons to it, but I think it could be something like India becoming the second most weighted country in the MSCI Emerging Market Index, China not looking as attractive as before, and hence India becomes the most prominent market where people have to now understand and go in depth in this market. So one should not just write off mid and small cap space in a hurry. Maybe this is the time that people are starting to explore this space. Now, talking about the investment themes, how we look at the themes while constructing a portfolio. So for this, it is essential to just take you to the backdrop of where we are in the country. Everything sounds euphoric in the context of market, but this is just to draw your attention how our GDP growth has been. You will see that we have come off from an average GDP growth of 7.5% from 2005 to 2015 in that decade to now at a lower level, 5.5%. So even though we might feel that everything is great, our GDP growth itself shows that everything that we are having right now is not in the best of the situation. And again, why is this so? Because there have been several measures taken by the government. So look at what happened, RERA was introduced in 2016. GST was introduced in 2017. Now, all these measures were difficult, as in difficult from this context of GDP growth. All these pulled down the GDP. PSU bank merger happened. So this is kind of repair work that was happening. Again, tax rate cut for the corporate that happened. So that gave a boost to manufacturing. And obviously the PLI schemes that we've been talking about, very encouraging. So this is about the Make in India and Atmanirbhar Bharat, and that is how it comes up. And this is how the beginning of manufacturing started in the country. So this is what we are trying to say, that while we are saying everything is good, from 2016 to almost 2020, we were seeing a lot of repair work happening in the economy, which is now starting to display in terms of good growth for the companies. Again, look at the capex journey, right? You will see for a very long time, almost FY6 to FY20 that we are saying, this is capex as a percentage of GDP. It moved in a very narrow range of 1.5% to 2%. For a country like India, which needs so much of infrastructure, this is like a very poor range. And even this government, which has been there since FY14, one really can't say that from FY14 they started taking up the capex spend up. This is where the repair work was going on and they didn't increase the spend. It's only in the last 3-4 years where this capex spend has started going. Right? So flattish. And this is now where you're seeing that, okay, the capex to GDP has now inched up to almost 3%. Again, budgeted capex spend. And again, we should be proud that as a country, we've had 27% CAGR of budgeted capex spend in the last few years. We would really be one of the very few countries who would have seen this kind of capex spend coming in. If I talk about the budgeted spend on railways, again, the CAGR there is 35%, another area. Just to again talk about, look at the national highways, right? One entire decade we spent going in national highways from 60,000 kilometers to 80,000 kilometers. This FY03 to FY13 was spent. And then in the next decade, look at the way highways have been constructed. From 80,000 kilometers, we've gone to 145,000 kilometers. So this is the trajectory change that we've been talking about that is happening. This is the ground level policies which do make a difference. Look at the inclusion which has happened with Jan Dhan. So this is the Jan Dhan accounts that we are talking about. We now have almost 50 crores of Jan Dhan accounts. So look at the kind of inclusion that has happened, financial inclusion that has happened in the country. And that is one big reason where we see that credit growth is inching up, because so many people have now come in the radar of this financial inclusion. Moving over to manufacturing from infrastructure. So again, manufacturing, how do we see picking up in India? government has been focusing on Make in India or Atmanirbhar Bharat. I think that focus is amply visible. How is it visible to us? We've seen domestic companies themselves aligning their supply chain from China to India. So there, I think just about 4-5 years back, various sub-segments that you might see. The pharma companies are importing APIs from China. Big shift from there has happened to India. Even consumer durables like ACs, almost 70% was being imported. Again, their shift has happened. Talking about other segments, again, luggage, for example, almost 50% was being imported. That is again now 90% plus is being manufactured in the country. So we'll have several such examples in various subsegments to show how the domestic companies themselves have realigned their supply chain to India. So we are consuming what we were consuming, but that same things are being manufactured within the country. Again, when we talk about MNCs, they want to make India as their regional hub. You have various reasons, China plus one, Europe plus one. Obviously, I'm not saying that one should be very bullish on these themes. All we are saying is earlier, where there was no say for Indian manufacturing smaller companies in the international market, today they get a say. Today, if their pricing is similar to China, then they get a say of participation because the MNC companies do want to diversify their supply chain. Defense indigenization has largely played out. We've seen that happening from 70% of defense import to now 70% indigenization. Has been a good journey, and we see that continuing further. Again, in the infrastructure bids that we see as a country, I think a lot of this infrastructure bids have now, there is a clear focus for the domestic companies. So earlier in the infrastructure bids, Chinese companies, if you talk about the last decade, they used to have a good say in the power or other space. But clearly the government has now aligned these bids in a manner that domestic companies get a certain preference. And overall, this is leading to a manufacturing ecosystem being built in the country. Now, this is something that we say is like the initial or the beginning phase in India. And again, why do I say that? India has largely been a consumption-driven economy. Today, if I have to find a consumption-driven large company, it's very easy to find those companies in India. But if I change those tabs and start looking for companies which are doing manufacturing in the country, I really would struggle today to find a company with revenues more than 5,000 crores. So, I'm not talking about MNCs. There are certain big manufacturing companies, MNCs, which are there in the country. But if you take them away, the domestic manufacturing companies are really very small in nature. I think this is one big reason why you're seeing this small and mid-cap companies doing really well, because this manufacturing ecosystem development, which is coming up within the country, is being supported by this mid and small space. Now, talking about the strong and structural theme of India, which we've always known, is the consumption theme that continues, and it's like the long-term theme. Look at the age profile of Indians. We all know it, but just to recap on the numbers. So we are a country of young customers. Right? 44% of our customers are less than 24 years of age. Again, comparing with one of the largest populated countries, China, this number would be at a sharp contrast at 27%. So this gap has never been as large the way we are seeing now, and it's only set to widen. And this is the high consumption category, already spending well. Look at the demographics chart of India, right? This is where you see this is the low age category. This is how you are aging out. So the way we will age as a nation, it's a very smooth graph. And if I have to just contrast it with China, look at the way China will age. You can see this big bulge which is present in this 45 to 55 segment. So in next 10 years, this entire segment will move to 65 age bracket, which will be like an aged economy. So very soon, China will be doing the battle that Japan has done for quite some time, which is dealing with this aged economy. If I have to again contrast India versus the other nations, I think it is very relevant and important. Even if you look at ourselves, our own consumption patterns, you will understand that consumption is very different for someone who is 25 years, somebody who is 30 years, and somebody who is 40 years. 40 years plus consumption really goes down. You're no longer out there shopping and buying as much stuff as you would have done at 25 years or 30 years. So today, as a nation, India, we are at the median age of 28, 29 years. Even by 2030, the median age of India is just 30 years. Contrasted with USA, 40 years, China, 42 years. So really old nations. And I've not even spoken about Europe here, which is anywhere 45 to 48 years. So I think that is one big difference that you will see, that consumption as a theme will remain in very few countries like India. I think the only continent that would be left would be Africa, still some time away. Talking about the per capita income movement, again, I'm talking about, a brief period starting from, say, 2010. And I've converted this dollar per capita to rupees and also to rupees per month, because that is what we understand easily. 2010, we used to have a per capita income of 5,000 rupees per month. 2015, this moved to 9,000 rupees per month. And today, as we are talking, it's 16,500 rupees. And you all can understand the difference of consumption that you can expect from someone who is earning 5,000. Branded consumption just doesn't come in. These are not the people who will go in for restaurants or buy any branded stuff. But when you're earning 16,500, once in a while, once or twice in a month, all these things become a certain. And the consumption varies. And as we are talking, this number will rapidly move towards 30,000, which is like a very comfortable zone. This is the pyramid profile of the households in the country. We all know 2010, how this pyramid looked like. You had a lot of houses in the bottom category. And this was the time that you really thought that penetration will do well. So anybody who could reach the bottom household could do very well. So this entire decade that we saw was the penetration decade in consumption. And consumption did very well. Today, as we are talking, I think numbers have started changing here. Look at the strugglers or the low income ones, they've shrunk. Look at the premium aspire categories, these have become bigger. And maybe in the next 10 years that we are going to see is going to be just the inversion of the pyramid, where the low income becomes smaller and the larger income becomes really big. So this is the premiumization theme that we are here to. So we strongly believe that penetration is the consumption theme that was there for the last decade. And this is the decade that we'll end up seeing the premiumization in consumption. And this one picture can give you a glimpse. So this is the customer that we were serving 2 decades back or 25 years back. And this is the new customer that we are serving. And you can just look at the difference in their needs of consumption. It's drastic. The earlier consumer is someone who has this guilt of consumption, whereas today's consumer has no guilt and doesn't mind spending even by borrowing money. So based on these things, if I come to the portfolio construct, how we look at the stocks, how we construct the portfolio, especially for the schemes that I manage, I think this is the pattern that I've been following, and it helps in looking at a variety of stocks as we are here. So first is the leaders or the consistent performers, 25% in the portfolio. Next is the challengers or the growth leaders, 50%. And then is the theme or turnaround, which is 25%. When I refer to stable or the leaders, these are the older companies, right? Good, consistent track record, good cash generating businesses, very stable in the portfolio. So these would be anything like a Hindustan Unilever, HDFC Bank, a TCS, very comfortable. They are there in the portfolio for stability and not for growth. So usually the positioning in them will be equal weight to underweight. The heart of the portfolio would be these high growth companies. In most of the sectors, you will find a couple of companies which are not so big, little bit behind, but they are growing faster than even the larger companies. So talk about IT companies, you name companies like Persistent. Talk about finance, you name companies like Chola. So every sector you will have these companies who are catching up, gaining market share, growing faster. So these are the companies where the risk is moderate and we are generally overweight here. They are really good in execution. And the best thing about them is that they're gaining market share. And this last bucket that we keep is this themes and turnaround bucket. Again, this is a very important part for the portfolio because this is something that helps us look at new ideas for the portfolio. So anything that we're talking about, digitization, new age companies, import substitution, travel as a theme coming up, renewables coming up. So all these comes in this category. We are not very certain how they would play out, but we definitely believe there is some potential in it. So the bets here that are there in the portfolio, they are limited in weights. Risk obviously is high, and hence the construct in this manner. So this is how broadly the stocks fit in and the portfolio is made. Just to conclude, how the drivers of investment are there in India. Again, services is something that have always done well as a nation for India. So near-term services again looks healthy. We earlier had only IT to support us, but now a lot of other business services are equally supportive in services. Manufacturing definitely has become a very strong medium-term theme. And as I spoke, it is the ecosystem which is being developed. So right now, maybe you do not have any large companies in manufacturing, but very soon, maybe a few years later, we'll be heading to an area where we'll have larger names. And again, longer term consumption remains the secular. So from a portfolio perspective, where we are overweight on, we are overweight on manufacturing, definitely. We are overweight on discretionary consumption. That continues, and autos. Where we are underweight, it's on the consumer staples. As we said, penetration is like something which will be taking a backseat in this decade. And global cyclicals, because we are positive on the domestic economy, we are underweight on global cyclicals such as metals and energy. Sectors such as banking, IT, pharma, for various reasons, we are equal weight. So banking, maybe we see the best of the numbers is behind us. Valuations are comfortable and hence equal weight. IT, earnings, there is struggle, but a lot of potential in the companies. We have positioned ourselves in a different manner, playing it through the companies which are changing their growth trajectory. So certain mid and small cap companies in IT is what we are liking. And in pharma, I think growth structurally has come down a little bit from what it used to be. We've seen 15 to 18% growth in the earlier decade in pharma. Today, the growth has slightly come down to 10-15%. So that is the reason we are equal weight in that space. Just to give a flavor of maybe the two large fund from the various mid-cap, large-cap positioning-wise, how we are positioned. So this is the large and mid-cap fund. So this fund necessarily needs to have 35% in mid-caps, 35% in large caps. So you can see here, large caps at 36%, mid-caps at 37%, and small caps at 25%. Now, very important to understand, this is very flexible in nature, the small cap allocation. Sometime last year, we used to have small caps around 10% in this portfolio, but we've been inching up this right from March this year. And this allocation stands at 25% because we see a lot of names, different smaller names coming up in the space. We do understand the concern on valuations, and hence, if we feel the valuations of any of the names in small cap has become expensive, we move out, but a lot of new ideas coming up in that space. This is the aggressive hybrid fund. If you look at the breakup here, you have large cap, you have obviously the debt category also present here, and again, the mid and small cap. So you can see good diversification across various markets. Again, we do not advise at this point of phase one should particularly go in only small cap fund or only mid cap fund, but diversified funds like this, I think it's something that one should still continue to invest. So yeah, this was the presentation, and I would be happy to take on any questions.
Thank you, Chinu, for a very insightful session, very interesting slides, and also very interesting questions coming up. For starters, I think there is a lot of keenness in understanding, current level valuations in large, mid, small. Earnings have always been very supportive in terms of building up a strong, robust stock market rally. We've always predominantly tracked the Nifty earnings. But what's the visibility that you see for calendar year 2024 or FY 2025 in terms of earnings growth? Do you see taperedness in the large caps and a strong earning rebounds in the small and mid?
Yes, Kripa, I think good question. Valuations is something that we already discussed in this presentation. Earnings growth. So usually in the environment that we are in, where we are seeing that the economy is just starting to pick up because GDP growth numbers have been subdued, and on the business cycle wise, we have to pick up. Even if I talk about interest rate, we are almost at the peak. So at these time when interest rate, you're looking at interest rate being cut maybe sometime next year, you're looking at GDP growth picking up. These are usually the times that earnings of mid and small cap will fare better. So even for our universe, when we talk about the earnings growth, for the large cap companies, the earnings growth looks a tad lower, around 13-14%. Whereas for the mid and small caps, the growth trajectory looks a bit higher, closer to 20%. So that is the comfort on earnings growth in that category.
Chinu, one very much, kind of more a complexity is that you have bank and IT dominating the large cap space in terms of weightages. We have incidentally seen both the sectors not doing well. In the recent correction, also large cap took a beating. Do we see over dependence of FIIs coming in to kind of propel a run up in the large caps? Do we see that segment getting into a time correction? Logically, a lot of people are talking about valuations are looking good and good time to get into large caps or focus 30 kind of products or Nifty 50. Predominantly, what are your views in terms of large caps? Tactfully, one should take a call over the next 6 months time period. Do we see a combination of time price correction there still?
So yeah, I think for the next 6 months, we are not talking of any re-rating potential in the market in view of the valuations. There could be volatility in the market, but at the same time, as I said, earnings scenario for the company still look healthy. When you talk about this view that one should invest only in large cap, I think it should be a combined view. Yes, large cap have the favor of valuation, but your mid and small cap have the favor of the earnings. In such a outlook scenario, it's a balanced view suggests that you should be investing in funds which have exposure to all the categories rather than being biased towards any of the categories. So if you ask me from my perspective, anything like a flexi cap or a large and mid category or a hybrid category, I think multi-cap category, these categories funds look really good. So again, not saying that valuations can go up further, but if earnings continue to be healthy, I think they can drive the market gradually over the next years.
Interestingly, Chino, you shared one of the charts where FII holdings in terms of mid caps have significantly increasing. We've always seen a dominant phase of large caps over the decades. But do you see liquidity to be a game changer in the coming years, both FII, domestic and offshore put together?
So I think this is one interesting point. Usually we've always connected movement of large caps with FII inflows, right? We've always said that once FII flows come, then large caps will do better. However, what I wanted to show here was the active FII interest that we are seeing. And anecdotally, when we have these meetings, sessions, we meet a lot of small and mid companies, definitely because of our exposure. The kind of interest that FIs are taking, I think this is not something that I've seen for quite some time. So there is a certain change that is happening. And again, I think we spoke about several changes being done in the system, right? GST for one was a big game changer, where you got a lot of these small cap companies to be very tax compliant, doing things the right way. They've got aligned to the system. Again, if you look at the way listing has been happening, a lot of small cap companies are getting listed. And there's a change in thinking, whereas the earlier promoters wanted to have the companies to themselves, did not want public intervention, etc. The younger generation promoters understand the value of listing. They know that it's easier to get money from the equity markets if you get listed. It's an easy branding way. So again, that is why they want to get listed. And you get to attract talent by giving them ESOPs, etc. So a lot of listing and names have been coming up in the small caps name again here as we talk about. So I think this is how looking at the overall scenario.
Much of thrust your PPTs were also on manufacturing and consumption. When we look at our own portfolios in HSBC mutual fund, we've done kind of a lot of stock picks in the small cap segment as far as consumption portfolio and our diversified equity portfolios are considered for manufacturing. Do we see the profit pool in small caps for manufacturing and consumption improving? Have you seen a trend there? And do you feel the consumption could be more a catch-up than manufacturing, considering manufacturing is still a segment which will evolve over a period of time?
So right, I think there are again two ways to look at it. Consumption, it has not seen a big run up as such in the last couple of years. So valuation in that space are not as heavy as we've seen some time back. Definitely consumption have always been high P stocks and that still continues, but that is some kind of comfort there. When I look at manufacturing, yes, the profit pool there is certainly set to rise. I think earlier in the presentation, I was mentioning that today, if I have to find any manufacturing company and it's not an MNC, I really struggle to find companies with 5,000 crore revenue plus. So that is the kind of situation. And I'm sure that maybe if you're talking a couple of years down the line, the situation may not remain the same. So that space is developing and government policies have played a very big and crucial role. The way they have been coming back, even laptop manufacturing, we spoke some time back. Mobile manufacturing, we've seen the shift that they want domestic manufacturing. Suddenly they put a rule on air conditioners that you cannot import in the country. So these bits and pieces, things are going on. And I think this manufacturing support is being developed. And today people know that with the support that the government is also lending, you do not have the uncertainty. So I think earlier there was always this uncertainty. Today you're manufacturing, but once China comes in, they have cheaper goods available. Your company would have to struggle with maintaining their business model. I think today that is not the doubt. Everybody is willing to kind of adjust their supply chain to the domestic markets. So that gives a lot of comfort. So more and more such companies in the manufacturing space are coming up. They are using private equity money, raising money from the markets, and hence building their overall infrastructure.
One interesting question which has come up is since there is a lot of debate on valuation stretch between large, mid, small, is it going to be a stock picker market next year or next few years?
No, I think that is one definitely true thing, especially when we say that markets are going to be volatile. In volatile markets, stock picking becomes the most crucial thing. And I think next 6 months, we are keenly looking forward to that. We know that there'll be volatility, but we would want to use this volatility to back the stronger names where we have good conviction and add them in this to our portfolio in this volatility, or increase weightages there. So look at next 6 years, 6 months or 8 months to be volatile, but a stock picker's market.
Okay. There's one more interesting question which has come in saying post-COVID, there has been a lot of churn and stock sector turnovers which are happening in the industry. Would we want to keep our churn ratio low? And when managing mid and small, how do we manage the overvaluations in the portfolio?
Right. So I think churn ratio, rather than somebody trying to do it artificially, is a lot dependent on fund manager style. So each fund manager has his or her own style, and churn depends on that. So there is no such rule that we've been following. Even within the company, you will see some of our funds have lower churn, whereas some of our funds have higher churn as such. So I don't think there is any restriction there. And then what was the next question that you said apart from that?
How do we manage in case we pick up a stock, it's overvalued? How do we manage our portfolio in that context?
Right. So valuation, I think, is something that plays a crucial role in adjusting the weightages in the portfolio. We've never tried taking the valuation as something like a pit stop, that it's expensive and should not enter the portfolio. That is not the approach we've taken, because that is how you can end up missing some of the key names which can really go on to become big in next few years. However, when there is comfort on valuation, we pile up on the weight. When we feel the valuations have become very stretched, overvalued, we'll do some kind of profit booking and reduce the weight of that stocks. So we use it to balance the weightages of the stocks.
Another very interesting question. Normally, every fund house introduces us in terms of their DNA. How do they run the show? Are you very growth specific quality stocks, or do you track the broad markets and you would want to hold large, mid, small, everything in your portfolio? Chinu?
I think as a fund house, again, especially if I talk about erstwhile L&T, which has now become HSBC Mutual Fund, the approach has always been to focus on a lot of mid and small cap names. I think our mid and small cap funds have been the largest funds. The number of names that we track itself in the space in our universe is huge. We are literally tracking around 250, 300 small cap names. So that is a big number. The approach fund manager wise, yes, it will vary. As to my approach, how I see it, growth orientation is definitely there, but it's not sticking to certain quality names, because you are out here to see how the market is evolving, how the space is evolving. And when I especially mentioned a space like manufacturing, we are into companies which do not even have a big track record. So forget about how to assess them on their past track record or going by the quality parameter there. So it depends on the various spaces that you're looking at. So yes, as I said, growth remains a driver. Valuations, we are cognizant of valuations. We are not indifferent to valuations. You will always see a very, very high valued company being a lesser weight in the portfolio, whereas a lower valuation, or where the valuations are comfortable, weight can be higher. At the same time, if that high valuation company does well and organically grows in the portfolio, weights can end up becoming high. So that can happen.
Now, Chinu, coming to scheme specific, there's one question. what strategy do we adapt for our aggressive hybrid portfolio? Would we be, if opportunity comes, take aggressive bets into mid and small, or would you like to keep it as a large cap bias portfolio?
So I think we've kept aggressive hybrid quite open. Even today, when I showed at the construct of the aggressive hybrid, you can see that the large cap weightage that we had in aggressive hybrid was around 40%, right? This is what we've shown, 40%, and the small and mid was around 20% in the portfolios. So I think we've kept it very open. We are open to adding sometime back small cap or mid cap weightages here would have been far lower at 10% each, and they have gone up to 20% in last 1 year. So if we see the scenario is good, there is no such restriction in this portfolio, and we will be happy to pick up companies. The only criteria being the companies have to prove them by that delivery of earnings. I think that is what.
One question to the large and mid cap is, would you personally would be biased towards mid cap more, or would you want to keep it as a healthy mix between large and mid? Alpha generation, will that be a key for a large and mid portfolio, or it will be very much similar to a flexi cap?
No, I think large and mid cap space is offering a lot of alpha generation. Today, if you look at the kind of alpha generation versus the benchmark that this category is done, is very healthy. Because you do not stick to only mid and large cap per se, the way you can look at the mix that we had shown. Small cap today is 25% in the portfolio, which is like the alpha driver. At the same time, you're not missing out on the stability part. It's not that you're very aggressively there on small cap. So if any correction happens, you have a good cushion of 38% in the form of large caps, which is present, which give that stability to the portfolio. So it's like a balanced approach. At the same time, just for alpha generation, I think small caps are playing a healthy role.
Chinu, you had done a lot of, given an insight on manufacturing. Do you feel, is it reasonable to say that the decade belongs to infra and manufacturing?
So again, as I said, the two themes, decade belongs to infra and manufacturing. Yes, that's the niche space coming up, still very small, will grow in size, but I will not write off consumption. Premiumization is a very strong theme. The way we've seen travel pick up, the willingness of people to spend in several categories like hospitality, I think that was just not there in the previous decade, right? People travel to 5-star only when they travel through companies, not on their own. I think today is just the reverse. Companies have become more cognizant of cost, whereas people on their own are willing to spend and travel in these places. So I think travel is just one name. I'm saying there are several other spaces which are seeing the shift from unorganized to organized. A space like jewelry, definitely it's not growing in volumes, but the shift from unorganized to organized is giving the companies very snacking, QSR, several other these smaller places in consumption also belong for the next decade. So I would say it's a mix of manufacturing plus discretionary consumption.
Some sector specific view, what is your sense in terms of the profit growth for IT companies ahead? Do we still see a lull period for sectors like IT?
So as I said, in IT, overall, if I look for the sector, earnings growth will not be very healthy because your large cap are seeing mid-single digit growth, right? It's quite low. However, you still have your mid-cap companies doing better. I think this is one, again, important change that has happened in IT space. Earlier, your mid and small cap companies used to be very small and dependent on few clients. Some $200 million average size. Client dependency used to hurt them a lot in down periods. This is not the case today. All those companies have grown up. Today, when we are talking of these next generation mid and small cap IT companies, they are $1 billion approximately in size. So they are not as fragile. If you look at the management changes, it's become stronger. These companies are giving you earnings growth, which is still in double digit. So there are few companies which are giving you double digit growth in IT. But if I go by market cap weightage overall for the sector, the growth will still be single digit.
One question I think which is more macro is that we of course wait for the Fed narrative on the interest rates for the next year. We have the geopolitical risk coming in. Anything which you feel would directly impact or can still be a knee jerk, or most of all the negative news has got priced in?
So I think geopolitically we've seen enough, right? In last 2 years, it's been a big thing that has happened geopolitically. Not expecting any more action, hopefully, on that front. When it comes to Fed, I think now it's been amply absorbed that rates are here to be higher for longer. I think in the last Fed meeting, when they said that, okay, they are pausing, they just kept a window open that maybe if there's need, they'll increase. But looks like they also called towards peaking of the cycle. So we have to pause here for some time. And definitely next year, I don't know when, June, September, whenever there's comfort, there could be a beginning of rate cut. Now, these rate cuts might not be massive. You're not talking of big rate cut and going back to those 2% kind of levels. But however, rate cuts call for a sentiment change. And that is something that we are waiting for next year. The way we waited for this tapering to happen the last year, right? That was the concern. That is how that sentiment is going to turn sometime next year. So
Okay.
yeah, looking forward to that.
Chinu, one question in terms of deployment of funds. If somebody has cash flow today, what should be the strategy from here on till the general elections? Or one should probably aggressively take a bet today?
I think the best strategy should be to go in for SIPs, SIPs, helping you investing in market at all levels. At the same time, going in for these mix or diversified kind of portfolios where you're not getting biased towards any category. So I am not of the camp who would say that invest only in large cap and leave these two out. Because as I said, if these two categories, small and mid, are giving you earnings growth, why you want to be out? At the same time, I'm not saying that, okay, be only in these categories for high growth, because obviously there's valuation discount. So I think mixed portfolios and SIP approach is like the best that you can do even heading into the elections. If at all there is any big volatility, 8-10% kind of correction, that is a time that you can look in for a chunkier investment.
So I think more or less we are done with the Q&A. My personal question to you, Chinu, if you have your cash flow, where will you invest? And would you have gold in your portfolio? Because that's a favorite subject everybody is talking about. We have had multi-assets as launches in the recent past. So gold has suddenly caught up attention more so because of the global turmoil. Where would you personally invest your money? And what will be the stack order? Is it going to be small, mid, large, or you'll get into your own funds, or you'll give some bit to the gold also?
No, I think very true. When it comes to my own personal money also, I will look at these diversified categories. And the way we talk about just diversification in the form of market caps, I think gold is also an asset category. And how it's crucial or important, that was amply visible in times such as COVID. When the entire market crashed, you could see that there are some categories like gold, etc., which tend to hold on to very well. So gold is more like a diversification. In India, gold also gets the currency benefit, because whenever rupee depreciates, the pricing of gold in India, you get that currency benefit as well, because we are pricing gold in INR. So you are indirectly playing two asset classes through gold in India. It's the gold asset class and it's the rupee versus dollar asset class that you. So yes, that can also be a part of the portfolio. Earlier investors would have done it on their own. Now you have an option of doing it through funds, because funds can put a certain amount in categories such as. So again, that adds to your diversification and is very helpful.
Thank you, Chinu. Thank you for this wonderful session. To all our esteemed partners who are present on the call, thank you for attending this session. I hope you found this very much insightful. Happy to please take your feedback. We have the feedback box. Please put in your comments. Festivities are about to begin. On behalf of HSBC Mutual Fund, wishing each one of you happy festivities ahead. Diwali ki shubhkamnaएं, and wishing you and your family and loved ones a happy Diwali. Thank you, Chinu. Thank you for the session.
Thank you.